Listen carefully. I am not speaking about a temporary move in silver or another cycle that fades with headlines. I am speaking about a structural transition inside the global monetary system that most people are not prepared to face. Silver holders in particular are being positioned inside a shift they do not fully recognize yet. For years, you have been told silver is secondary, unstable, and dependent on sentiment that disappears the moment markets tighten. But what you are not being told is that the system doing the pricing is itself under sustained strain. We are living inside a long debt expansion regime. Governments have accumulated obligations at a pace that exceeds real economic growth. Central banks have expanded balance sheets, suppressed interest rates, and created the appearance of stability through intervention. But that stability is not organic. It is maintained, and maintained systems always carry delayed consequences. Ray Dalio's framework on long-term debt cycles makes this point clear. These systems do not fail in a single moment. They move through stages: expansion, overextension, tension, and then forced adjustment. The uncomfortable truth is that we are no longer in the expansion phase. We are in the tension phase, where confidence becomes the most important variable in the entire system. And confidence is not a balance sheet item. It is a perception. Once that perception begins to weaken, pricing behavior changes long before official acknowledgement ever arrives. This is what most investors miss. They assume asset prices reflect stability, productivity, or long-term growth. But in reality, much of today's valuation structure is driven by liquidity conditions. When liquidity expands, everything appears controlled. When liquidity tightens or loses effectiveness, hidden imbalances begin to surface. Stocks can rise in such environments. Bonds can hold for longer than expected. Real estate can appear resilient, but underneath it all, debt continues to compound faster than the system's ability to sustainably support it. That gap is the pressure point. Silver is positioned differently inside this structure. It is not just an industrial metal. It carries historical monetary identity, and in every major cycle where confidence in currency systems weakens, assets with monetary memory begin to behave differently from conventional commodities. That is why discussions around extreme revaluation scenarios like $50,000 should not be dismissed as fantasy or enthusiasm. They should be understood as reflections of what happens when the unit of measurement itself loses stability. You need to understand this distinction. When people hear large numbers, they instinctively assume irrational speculation. But in reality, what often changes is not the asset in isolation, but the credibility of the currency used to measure it. When monetary systems stretch beyond their sustainable limits, the first stage is not collapse, it is distortion. Prices begin to behave inconsistently. Traditional relationships between assets weaken. Models that once worked begin to fail under new conditions. Most participants do not recognize this phase because they are trained to focus on price direction rather than structural pressure. But the real signal is not whether silver moves up or down in a given week. The real signal is whether the underlying system is becoming more dependent on intervention to maintain equilibrium. Rising debt servicing costs, expanding fiscal deficits, and repeated policy responses that only delay adjustment are not isolated events. They are components of a system under increasing strain. At some point, the behavior of capital changes. Investors stop asking which asset is outperforming and begin asking which asset will retain value if the measuring system itself weakens. That is the turning point where silver transitions from ignored commodity to strategic hedge. I want to be precise here. This is not about excitement or prediction. It is about recognizing behavioral shifts in capital allocation during periods of monetary stress. These shifts do not announce themselves in advance. They develop quietly, then accelerate once recognition spreads. Silver has already spent a long period in compression. It has moved sideways in real terms, absorbed selling pressure, and shaken out speculative conviction. On the surface, that looks like stagnation, but structurally, compression is not inactivity. It is stored pressure, and pressure does not disappear on its own. It releases when conditions change. In the next part, I will break down how liquidity rotation actually begins, why silver responds disproportionately compared to larger asset classes, and what happens when confidence transitions from paper-based systems into tangible stores of value. What you must understand next is how these transitions actually begin. They do not start with headlines or official announcements. They start with liquidity behavior, changing in subtle but measurable ways. In normal conditions, liquidity flows into the largest, safest, most established financial instruments first. Government bonds absorb capital because they are considered stable. Large cap equities absorb capital because they are liquid. Real estate absorbs capital because it feels tangible and historically reliable. But in stressed monetary environments, this flow begins to distort. When debt levels reach extreme thresholds and interest obligations consume a larger share of fiscal capacity, central banks are forced into a difficult position. They must either maintain tightening conditions to preserve credibility or reverse course to prevent financial stress from escalating. This creates instability and expectations. Markets do not respond well to uncertainty about monetary direction. They begin to price in volatility before it appears in official policy. This is where the rotation begins. Capital slowly shifts away from assets that depend heavily on policy stability and begins searching for assets that do not rely on institutional confidence. This is not a dramatic exit at first, it is a gradual reweiging inside portfolios. But the direction is what matters. Silver becomes relevant at exactly this stage because it sits at a unique intersection. It is both an industrial input and a historical monetary instrument. That dual identity means it reacts to two different forces at the same time. On one side, industrial demand provides a baseline level of real-world utility. Silver is embedded in electronics, energy systems, medical applications, and modern infrastructure. That demand does not disappear in financial stress. On the other side, monetary perception begins to shift when trust in currency systems weakens. And when that shift happens, silver is no longer evaluated purely as a commodity. It begins to be evaluated as a store of value with constrained supply. This is where elasticity becomes critical. Silver is a relatively small market compared to global financial capital pools. That means even modest reallocation from large institutional players can create disproportionate price movement. Liquidity does not absorb smoothly. It impacts pricing aggressively. Most investors underestimate this because they assume large moves require equally large physical demand changes. But in financial markets, repricing often comes from perception change, not consumption change. Once institutions begin adjusting models to account for currency instability, allocation frameworks shift. Silver moves from non-essential exposure to strategic hedge consideration. That reclassification alone is enough to alter demand dynamics significantly. At the same time, supply does not expand easily. Silver production is tied to mining cycles, geological constraints, and long development timelines. It cannot respond quickly to sudden demand shifts. That imbalance between fast-moving capital and slow-moving supply is where acceleration comes from. Ray Dalio's debt cycle framework helps explain why this environment is structurally sensitive. In late-stage cycles, debt does not simply accumulate. It begins to compound in ways that exceed the system's capacity to service it without further interventions. That intervention, however, comes at a cost. Each round of liquidity support weakens the currency's purchasing power relative to real assets. It creates a feedback loop where stabilization today increases instability tomorrow. This is why inflation in these environments is not just about consumers' prices. It is about currency credibility. Once credibility begins to erode, capital does not wait for confirmation. It begins to reposition preemptively. That preemptive behavior is what drives rapid repricing events. Silver does not need widespread adoption as money again to move dramatically. It only needs enough participants to question whether existing currency units will maintain their purchasing power over time. Doubt alone is sufficient to change allocation behavior, and doubt rarely develops evenly. It appears gradually, then suddenly concentrates when a triggering event occurs. That event could be a liquidity crisis, a sovereign debt stress point, or a policy shift that signals limits to intervention capacity. But the trigger is not the cause. The cause is structural imbalance accumulated over years. This distinction is critical. When people look at silver price movements, they often focus on immediate catalysts. But in reality, catalysts only reveal conditions that were already forming beneath the surface. They do not create the pressure. They expose it. What this means for silver holders is that the positioning phase occurs long before recognition becomes mainstream. By the time financial media begins discussing extreme valuations or structural repricing, much of the move has already progressed. That is the pattern seen across multiple historical cycles. Early accumulation happens in periods of disbelief. Acceleration happens when disbelief turns into acknowledgement. Exhaustion occurs when acknowledgement becomes consensus. We are not at the exhaustion stage. We are still in the phase where structural pressure is building while most market participants interpret conditions through short-term fluctuations. This creates a gap between perception and structure, and that gap is where opportunity exists. Silver's compression phase has already persisted for an extended period. During this time, volatility has discouraged weak conviction holders and reduced speculative positioning. That process is often misinterpreted as lack of interest. In reality, it is the clearing of excess positioning. Markets do not move strongly from crowded conditions. They move when positioning is underweighted relative to underlying pressure. That is the environment that forms before repricing. In the next part, we will examine what happens when this pressure reaches a release point, how confidence transitions accelerate price discovery, and why historical monetary shifts tend to compress large adjustments into relatively short time windows. Now, you need to understand what actually happens when this kind of accumulated pressure finally begins to release. Markets do not transition smoothly during monetary stress periods. They do not gradually adjust to new information in a clean, linear way. Instead, they move through discontinuities. Periods of apparent stability are suddenly interrupted by rapid repricing, and those repricings often appear disproportionate to the immediate news flow. The reason is simple. The system is not reacting to news. It is reacting to delayed recognition of structure. When confidence in the monetary framework begins to weaken, capital does not wait for perfect clarity. It moves defensively first. That defensive movement is what creates acceleration in assets that are sensitive to trust, scarcity, and liquidity constraints. Silver sits directly inside that category. At this stage, the key transformation is psychological. Investors stop evaluating assets purely on yield or growth potential and begin evaluating them on survivability under monetary uncertainty. That shift is subtle at first, but once it crosses a threshold, it becomes self-reinforcing. As more participants move toward assets perceived as durable stores of value, price itself becomes a signal. Rising prices attract attention. Attention brings validation. Validation brings more capital, and that loop compresses time. This is why transitions in monetary regimes often appear sudden, even though the underlying buildup takes years. You also need to understand something critical about liquidity during these phases. In stable environments, liquidity is deep and distributed. In stressed environments, liquidity becomes uneven. It concentrates in certain assets while disappearing from others. That unevenness creates volatility. Silver, because of its relatively small market size compared to global capital pools, becomes especially sensitive to this effect. When institutional or macro-driven capital begins rotating even modestly, the impact on price is amplified. The market does not absorb the flow smoothly. It adjusts sharply. This is not speculation. It is structural mathematics of market size versus capital allocation. Now combine that with supply constraints. Silver is not produced at a rate that can rapidly adjust to financial demand shifts. Mining output is slow to respond. Above-ground stocks are limited relative to financial markets. That mismatch between financial demand speed and physical supply rigidity creates the conditions for sharper pricing when sentiment shifts. But the most important driver is still confidence. Ray Dalio's long-term debt cycle framework emphasizes that monetary systems move through phases where debt growth eventually exceeds the system's ability to maintain stability without increasing intervention. Each intervention delays adjustment but increases the magnitude of eventual rebalancing. This is the compounding effect most investors underestimate. They assume intervention smooths out risk permanently. In reality, intervention often shifts risk into the future while increasing its scale. That means when adjustment finally occurs, it is not proportional to the last visible change. It reflects the entire accumulated imbalance. Silver becomes significant in that moment, not because it changes fundamentally, but because the perception around currency stability changes when confidence in fiat systems weakens. The reference point shifts. Investors begin recalculating value in terms of scarcity rather than nominal units. That is where extreme repricing scenarios become mathematically plausible under certain conditions of currency dilution. It is not that silver jumps to a number, it is that the unit used to price it loses purchasing power while silver simultaneously reclassifies from commodity to monetary hedge. That dual movement creates the appearance of exponential growth. Historically, in every major monetary disruption, tangible assets have outperformed paper-based claims during the adjustment phase, not because they became more useful overnight, but because they were less dependent on confidence in the system issuing the currency. This is the key distinction. Silver does not need mass adoption to reprice significantly. It only needs a sufficient breakdown in trust for capital to begin seeking alternatives outside traditional financial claims. And once that search begins, it does not unfold evenly. It accelerates as awareness spreads. Most participants will not recognize the beginning of that acceleration. They will interpret early moves as volatility or temporary speculation. They will wait for confirmation that feels safe, structured, and widely accepted. But in transitional phases, safety is a lagging indicator. By the time consensus arrives, the repricing mechanism is already well underway. This is why positioning matters more than prediction. The exact trigger is rarely known in advance. It could be debt stress in sovereign markets, inflation resurgence, currency instability, or policy limitation becoming visible in real time. The trigger itself is secondary, the structure is primary, and the structure today shows accumulated leverage, rising fiscal pressure, and increasing reliance on intervention to maintain equilibrium. That combination does not resolve quietly. It resolves through adjustment. Silver's role in that adjustment is not emotional or speculative. It is functional within the logic of scarcity and trust erosion. When financial claims become less certain, assets with physical constraint and historical monetary association begin to attract capital disproportionately. That is the transition you are watching for, and it does not require everyone to agree for it to begin. It only requires enough capital to start moving defensively. When that happens, repricing is not gradual, it is forced by flow. This is the final structural point you must understand. Markets in late-stage cycles do not move because participants reach consensus. They move because constraints force reallocation. And when constraints dominate, price becomes the mechanism of adjustment. That is where silver enters its most sensitive phase of movement.